There have been some fairly brutal equity market sell-offs at the beginning of 2022, and many people are asking whether I've triggered my market crash shopping list. So in this video, I'm going to talk about how I assess whether to buy the things on my list and also the reasons behind the shopping list. It's not so that you can copy my trades, it's more so that you can get inspiration about how you can reframe market crashes as a buying opportunity. So let's look at my market crash shopping list and whether I've triggered it in a bit more detail. Let's begin with why I have the market crash shopping list. And the reason why is because when there is a crash, people think it's apocalyptic and that markets will never recover. Whereas as an index investor, this is just a buying opportunity. And so anything that helps me reframe these crashes as something where I don't need to panic, but rather to seek out opportunities is a positive. Now bear in mind the things which go into this crash shopping list will only be in my fund portfolio. That's 10% of my overall investments, and I never take too much risk with that portfolio. For the rest of my portfolio, my core, I've carried on drip feeding into global equity, just as I would normally. Let's begin with Tritax Big Box. If you're not familiar with it, it's a real estate investment trust that buys lots of warehouse space, and it strategically places those warehouses close to centres of population, but also major transport routes. So here you can see the 25 sites that it owns across the UK. Now, one of its big customers is Amazon, and you can see when Amazon's share price sold off, so did that of Tritax Big Box. So for me, this was potentially an opportunity if the valuation looked attractive. What I didn't want to do was to buy Tritax Big Box during this huge rally following the pandemania. Here's an FT story talking about how the growth warning from Amazon, remember it wasn't a profit warning, they're still profitable, actually dented the share price for many logistics companies, because these companies obviously benefit from being part of Amazon's infrastructure. So in the UK, that was Segro and Tritax Big Box, and in the US, that would be Prologis. So if any of these were funds that you like, what you should really be thinking is this a good opportunity to buy those now at a more attractive valuation, a better entry point? Now, in the case of Tritax Big Box, for the UK version, it's an investment trust. And that means one way to look at it is in terms of the price of the fund relative to the value of the assets which it owns. That's called the price to NAV ratio. And NAV is just short for net asset value. So on this top panel, you can see in blue the net asset value per share in pounds, and the red line is the price of the fund. Sometimes the price is above the net asset value, sometimes it's below, and that's what you can see in the bottom panel. When it's trading at a premium to net asset value, it's shown in blue, and when it's at a discount, it's in red. So for example, in March 2020, you can see it was at a sharp discount to its net asset value. What's interesting is that after the Amazon results, yet again, it's at a discount to the net asset value. So I took this as an opportunity to buy Tritax Big Box. So this is one element of my market crash shopping list, which I've triggered. Now, the reason why I'm not panicking too much about Amazon is because that only makes up about 17%, maybe even a little bit less, than the revenue source for Tritax. There are many other distributors of goods and services in the UK which rely on their infrastructure, such as lots of supermarkets, Morrisons, Tesco, the Co-op, for example. And so it's not absolutely dependent on just one company for its revenue. Also, many of the leases which the company has, which generate the revenue, are very long-term leases, with greater than 15 to 20 years to run. But still, if there is an update to the net asset value, I'll be watching that very carefully, because it could be that that net asset value will drop as people reassess the value of infrastructure in the UK, particularly if we have something like a deep recession. But still, I think this is a reasonable entry point, and if the price drops further, I may even consider adding more to my holding. Now let's think about Scottish Mortgage Investment Trust, which is the UK equivalent of Cathie Wood's ARC funds. If I plot the returns of Scottish Mortgage, which is here in red, against ARC-K, which is in green, and the S&P, which is in blue, you can see that it responds very similarly. So there was a big sell-off in March 2020, and then during the pandemania rally, when growth was a huge outperforming factor, its response to the upside during that rally was phenomenal. But then, not particularly surprisingly, in November of 2021, that went into reverse, And now ARK-K has given up all of its gains since 2014 relative to the S&P, whereas Scottish Mortgage hasn't yet done that, at least not yet. But what I do like about Scottish Mortgage is if you look at it on a risk-return plot with high risk on the right, low risk on the left, low return at the bottom, high return at the top, and it outperforms all of Cathie Wood's funds and the Nasdaq. And if you look at the risk of the fund, which is where we are on the x-axis, it's got a volatility of around 28%. Whereas if we look at the ARK-K fund, that's got a volatility which is closer to 35%. So certainly over this period since 2014, it's had a lower risk and a higher return than Cathie Wood's ARK funds. Now it is an investment trust, so we can compare the price with its net asset value. However, for this fund, I don't think it's particularly informative because it is fluctuating hugely at the moment. The red line on this graph is the price of the fund, and the blue line in the top panel is a net asset value per share. The two tend to track each other quite closely, and at the moment, for what it's worth, it is trading at a discount to the net asset value. However, this is just a kind of race to the bottom as the assets which it's got are actually downgraded. I'm not convinced that this is a really good indicator that this hasn't got further to fall. What I find more informative at the moment is to look at the valuation of growth stocks in the US versus value. Of course, people pay a premium for growth. That's why the blue line in this graph is always above the red line. But notice the dispersion is still very large. People are still willing to pay a very large premium for growth, much more than you usually get historically. So I still think that growth has further to fall in the United States, and a lot of the exposure for Scottish Mortgage and for ARK is with these growth stocks. So I'm not convinced this is a great time to pull the trigger on this fund, at least not yet. What I'd be looking for is for valuations to fall further, but also for this premium for growth to compress closer to historic averages. Also, if we look at some of the largest holdings of Scottish Mortgage, many of which are held in common with ARK, you can see that it has exposure to Tesla, for example, which I still consider to be overvalued, but also lots of Chinese stocks which potentially could have trouble ahead. I still don't think we're out of the woods when it comes to revaluation of Chinese equity, for example. So at least for now, I will not be pulling the trigger for Scottish Mortgage. If you're interested in the interaction between markets and macroeconomics, why not sign up for our free weekly market roundup? I publish it every Friday. I try to keep it punchy and interesting. Most people just look at the funny dog tweet at the end of it. But if you do want to learn more about that, just click on the link beside me or look in the description beneath me. The next two items are both equity funds. One's a global quality fund and another one is a battery thematic fund, but both are indirectly affected by the valuation of equity globally. So this is the forward price to earnings multiple for the S&P 500 in the United States. What I like about this is that it's forward looking. It looks at all available information. It's a bottom up forecast going from the single stocks in the S&P 500 all the way up to the index as a whole. And its long-term average is around a 15 times multiple. So that would be this line here. The dashed green line is the 5-year average. The dashed blue line is the 10-year average. And you can see that so far we've gone through both of those, but we're still not at the long-term fair value measure. But certainly what you can say is that the US is no longer very expensive. It's now getting closer to fair value. But remember that equity usually overreacts when markets are selling off, and instead of going to fair value, it'll go to depressed values, such as it did in March of 2020 when it went to a multiple of 13 times. And after the global financial crisis, this went down to a multiple of 8 times, which is right at the bottom of the graph. So all we can really say at the moment is that equity is not egregiously expensive. Now there's another measure of fair value which is worth looking at because this one also takes into account the level of interest rates. So this is created by Robert Shiller. It's published on his website, his Irrational Exuberance website. And when the value of this is high, that means equity is cheap. And when the value is low, it means equity is expensive. Currently, that's not looking particularly cheap. And the reason why is that interest rates have increased hugely over the beginning of 2022. In turn, that means that you'd expect equity to be cheaper. And while it has derated, it hasn't derated as much as real rates have increased. So this measure of valuation has been cheaper about 62% of the time since 1881. What I've done here is I've marked percentiles showing when it's cheap and expensive. Blue is cheap, red is expensive, and it's actually closer to the expensive band than it is to the cheap one. So certainly, given where real interest rates are now, equity in the United States is not looking particularly cheap. And that means in turn that I don't necessarily want to get broad equity exposure right now. I might consider particular bargains like Tritax, but for the overall market, a global index, for example, like quality, I may not choose to buy that now. Now, for global equity exposure in my fund portfolio, I might want to try and beat the global market. And for that, I'd choose a factor tilt. And my favorite factor is quality. Now, the definition of quality depends on who you ask, but from MSCI, the index creator, they have 3 criteria. The first one is that these stocks have to have a high return on equity. The second criteria is that the profits that they generate are steadily increasing. And the third criterion is that the company's not taking too much leverage. That increases the business risk because if it can't meet its debt payments, the company could become bankrupt. Now, historically, you can see that that's beaten the MSCI World Index by a fairly large and consistent margin. Plus, intuitively, I just like the factor. Another thing I like about it is that it has a low Ulcer Index. In other words, the falls from the previous all-time high tend to be relatively short, but also not particularly deep. In this top panel, I'm comparing MSCI Quality, this is USA Quality, with drawdowns for the MSCI Value Index, also for the USA. Now, the Ulcer Index is smaller for quality than it is for value, and that's because its drawdowns tend to be shorter, but also not as deep. What's kind of interesting is at the beginning of 2022, the drawdown's been bigger than it was for value. That's because value has done particularly well at the beginning of this year. But still, if we do a risk-return plot where the risk this time isn't volatility, but the Ulcer Index on the x-axis, I like these 3 factor funds. Notice that quality doesn't have a particularly high Ulcer Index, whereas if we compare that with growth, that does have a very high Ulcer Index, and its Ulcer Index is slightly lower than that of momentum. Perhaps that's because momentum suffers when markets reverse. For example, when we go from a growth trend to a value trend, as we did this year, momentum can take a while to pick up on that trend and underperform as a result. And the returns you can see here are from MSCI indices starting in 1988 up till 2022. So certainly it gives a fairly good trade-off between return and risk, which is something I like very much. Notice also that the Ulcer Index is lower than that of USA Value. There are various flavors of quality which you can choose from. I've shown about 5 of them here. There are variations on the quality theme. So for example, you could go for world quality. That's these 2 top funds here. Or you could go for quality dividend growth. So that combines value and quality. Because remember, high dividend is also a value measure. So you don't necessarily have to go for global quality. You can actually combine factors if that's what you prefer. An investment theme which I like is batteries. So one example of that would be the Legal & General Battery Value Chain ETF, which you can see plotted here in red versus the S&P tracker SPY in blue. Now immediately you can see this is a popular theme. And that's the trouble with thematic funds. Once they become popular, they become overvalued, and as a consequence of overpaying for them, you'll underperform long term. So it's certainly true that this fund has sold off since the beginning of the year, but it hasn't sold off enough for me to think that it's now attractive. I still think there's a lot of euphoria baked into the prices of these stocks. But again, this is one I'm certainly going to keep an eye on. And finally, let's think about high yield credit. So this top panel shows you the price of a fairly standard high yield fund in the United States. I've used this one because it's got a lot of price history and dividend history, and this one's managed by Janus Henderson. Now notice that recently the price has been moving down fairly sharply, and that's because all risky assets have been selling off, including equity, but high yield is no exception. The reason why you buy these funds is to get access to the income stream which they generate. And that's what I show in the middle panel. Notice that recently, the smoothed out income that you receive for high yield has been falling. And that's because yields have been falling, but also because credit spreads and that's the additional income you receive for taking dodgy credit risk, that's also been very tight. But still, it is a high income relative to other asset classes. So what you want is to buy that income stream when its price is depressed. How can you measure that? Well, you just take the dividend and you divide by the price. And that's what you can see here in the bottom panel. Notice that as the price of the fund fell, the dividends didn't change much because those change quite slowly. But because we're dividing by price, the yield has been increasing. So what's the threshold for a reasonable dividend yield? Well, if we look back in history to 2008, say, the yield got above 8%. And if we look back to March of 2020, it got above 7%. So if we do reach those kind of levels, we're still at 6%, then it could be interesting as a purchase as part of my market crash shopping list. But we're not quite there yet. Still, this is one to watch. So as Warren says, it's good to be greedy when other people are fearful, and it's certainly true that people are now getting more fearful. Valuations are coming down closer to the kind of fair value for the S&P, but I still think growth is trading at something of a premium. So I still think there could be further to fall, and I think there'll be better entry points. But there are certain opportunities already, for example, Tritax, if you are selective. And I will be talking about those activations of my market crash shopping list as each of them happens. Now, don't forget our offer. We have our free weekly market roundup. You'll find more about that by clicking on the link beside me and in the description beneath me. And as always, thank you for listening.